Hi everybody, Jeff Yasteen here. By the way, make sure to keep following me on social media, subscribe to my YouTube channel and so on. Now, back on March 24th, I noted investors, or what we called investors' number one bear market mistake. Now I'm going to tell you about the number two bear market mistake, or we could call it a bull market mistake, considering everything since then. More on that and where I see this market going in the next few weeks. I'll do that in the back half of this video. But mistake numero uno, I said at the time, and remember the market was plummeting back then in March, seemingly with no end in sight. But I said mistake number one was paying attention to all the doomsayers attempting to predict the length, severity, and ultimate bottom of said bear market. And I went on to recommend TJX Companies, that's the TJMaxx discount retail chain, as a stock that you should buy now rather than wait for the all clear signal, which would only come when the price will be much higher to buy. And if we take a look at the chart since then, the stock is more than 30% higher. And as it turns out, March 24th was the bottom for that bear market panic, or whatever you want to call it. Stocks, of course, have been moving higher ever since, including TJX shares. So here's bear market mistake number two, or we could also call it bull market mistake number one, where things get overheated. Don't stay too long at the rally party. Sell into strength, and that includes shares of TJX, now that we have a nice gain there. Yes, the bear market is technically behind us. Good riddance. I have no idea if it comes back again or not, although I certainly have my suspicions. But when I first wrote about TJX in March, the stock was trading at a PE ratio of 13, ultra low valuation. And I said the last time TJX was trading at that PE level or lower was in the waning days of the 2008 financial crisis. It can't get much worse than that. And now, well, the stock, like so many others that are getting bid higher and higher by investors at the present time, got real pricey real fast. So if you add up the profits that Wall Street expects TJX to report over the next 4 quarters or so, it's what analysts call forward-looking, or they sometimes abbreviate as NTM, forward-looking over the next 12 months, it's roughly $1.56 a share in earnings. Now, that number, if you divide that into the current stock price of around $53, gets you a PE ratio of nearly 34. Also, sometimes analysts will calculate a company's profits based on an LTM, or last 12 months basis. So looking backward, over the last 4 quarters, TJX earned around $1.09 a share. Now divide that into the current stock price, and you get a PE ratio of 48. So no matter which way you slice it, both PE ratios are the highest valuations that this retailer stock has ever traded at, going all the way back to its IPO in 1993. So it shows you just how quick this huge market rally has come from historically undervalued in a retailer like this to wildly overvalued in 3 months' time. And we can point to stock after stock that has gone this same route over the last 3 months. So do yourself a favor and take some profits off the table and do it now. So with that out of the way, let's do a little bit of a review from a technical analysis standpoint of where the overall market is going, or where I see it going, my opinions, because I think where the overall market goes is going to have a huge impact, of course, on the vast majority of stocks. And I think we're hitting what could be a very important and potentially dangerous time for many investors in terms of the possibility of losing money when you're buying stocks and initiating brand new positions at a point where things may be peaking. And that certainly is where I see things going, the way things are progressing right now. So in front of me here, this is the S&P 500 chart. And I've been showing my subscribers at Total Wealth Insider this chart for the last 2 to 3 months or so, ever since the market bottomed down here in late March. And what I've been saying is right here, gaps were made to be filled. And right here between roughly 3,250 and roughly 3,300, there's this open space, this open gap between those two regions of the market, and it opened up back in late February as everybody realized the impact of the COVID-19 virus, or the potential impact, and where the damage that might wreak on the economy, and of course the damage that it did wreak on both the economy and the stock market. So with that in mind, we have this gap here, and look what's happened since then. We've had the market just continue to work its way higher and higher, and this is despite so much skepticism on the part of professionals and many retail investors as well for, I'd say, the first half of the rally going into roughly mid-March here. And at that point, basically everybody got sort of the new religion and bought into this thing. We had one peak going up into June 9th. And here we are, a few weeks later, and we're back to basically looking to close this sort of mini gap here, and of course, this next gap here. And that is what I expect to happen over basically the next 2 to 3 to perhaps 4 weeks between now and the middle of July. If I stretch this chart out a little bit here, again, here's this gap from February. I think we're going to continue to close higher, close in on this gap here. And this red line, the vertical red line here marks July 6th. So that's the first trading day after we come back from the 4th of July holiday, which is a Saturday, and we all have off and the banks are closed and the markets will be closed on July 3rd. And I believe that the market is going to continue to follow this lightly drawn blue trend line here and break through this, this gap that exists. At that point, that is the area that I feel will be at the most dangerous. Gaps exist as a sort of magnet. It doesn't mean that they get closed immediately, but often on a big impulsive move like we saw with the stock market, a panic-driven move, you'll often see both in individual stocks and in indexes a rebound move higher to close that gap. And the reasons behind all that are just far too technical and in many cases sort of mysterious as to why these things happen, except that it's sort of like unfinished business. So I express it as a magnet that draws prices towards it. And what has happened since late March? The market has continued to be drawn towards this gap. When the market closes this gap, when it fills the gap, as we call it, I think that is the point where we'll see the market and the technicals begin to roll over. That will be the peak. I think that's where we're headed. And the reason why I'm so concerned about it is because often when you see these gaps get filled, again, for individual stocks or for indexes, often it brings out all the folks who are sitting on the sidelines who are saying, I'm not going to buy this stock, or I'm not going to invest in the market here. It's too dangerous. And they watch the market move higher and higher and higher, and then it crosses this gap, and on the chart it'll register as a couple of big moves, big percentage moves for the day, and it's suddenly people feel compelled to jump in. And this is the point where all those fence sitters and a lot of people who are bearish tend to say, I can't stand it anymore, I got to buy this thing. And that is the point where the trap is laid. And the larger investors, the smarter institutional investors, begin to phase out of the market. And I think we're already seeing evidence of that, not just here, but in the NASDAQ as well. In fact, I'm going to bring up a chart here of the NASDAQ Composite Index. And there's a lot of lines here on the chart, but the one I want to draw your attention to is this one right here, this blue-purple line that exists right around 10,350 on the NASDAQ Composite Index. You can see we're very close to touching over it. Well, what is that blue-purple line? And I don't want to make this too crazy here. And so what I want to draw your attention to on this chart is that we're closing in on what amounts to a potentially very important sort of technical point. And a lot of people don't necessarily believe in technical analysis. I just look at it as a tool. I do fundamental analysis. I like to look at technical analysis. I also like to do things like cycles, just because they're all tools. None of them work 100% of the time. Nothing ever does in the stock market. But you know what? If you have these extra tools and you have some working knowledge of how it all goes, sometimes it provides a potential answer where other aspects, other studies of the stock market do not. So that's the danger that we all face here as we look at the stock market. We are faced with a period where we have very high stock prices, and either earnings growth accelerates to catch up and better support those prices, so you don't have these PE ratios that are so far historically out of whack, or the sort of more bear market or bearish sounding narratives move back into place in the second half of the year. That's the thing we need to pay attention to. And until then, I am Jeff Yasteen wishing you the best of goodbyes.